Oh, wait, let's unpack this. Williams Sonoma just dropped their Q2 2025 results.
Mm-hmm.
And they've got some, well, really interesting numbers and a revised outlook. So today, we're diving deep into what these results truly mean for the company and, the wider retail picture for you.
Right. Our mission today is really to break down their surprisingly strong performance.
Yeah.
Look at the key financial drivers, and then connect that to their updated guidance and the, let's be honest, significant challenges ahead, especially tariffs. That's the big one.
Absolutely. Tariffs loom large. But first, what a quarter.
Mm-hmm.
Seriously, Williams Sonoma didn't just meet expectations. They kind of blew past them.
They really did.
Looking at those headline numbers, comparable brand revenue up a solid 3.7%,
Mm-hmm.
which is pretty impressive when, Wall Street, FactSet said, was looking for maybe 2.6%.
Yeah, beat it comfortably. And what's really fascinating is how they did it. It wasn't just like one hero brand.
Right.
No, all their brands, Pottery Barn, West Elm, the namesake, Williams Sonoma, Rejuvenation, all positive comparable comps.
All of them. Wow.
Yeah, and growth across the board, too. Furniture, non-furniture. Both retail stores and e-commerce.
So really broad-based.
Totally. Sales overall climbed to $1.84 billion from $1.79 billion year over year. Again, beating the analysts who expected about $1.83 billion. It really paints a picture of a company, well, firing on all cylinders.
That diversified portfolio seems key then. In this kind of market, having those distinct brands, it feels like a real advantage, doesn't it?
Oh, absolutely. I think it speaks volumes about how they've invested in keeping those brand identities separate,
Right.
Each one has its own following, caters to different tastes, different price points. So if one area slows down a bit, another can potentially pick up the slack. It buffers them from volatility.
Yeah, that makes sense. It suggests a really well-managed strategy there.
Definitely.
Okay, so beyond the top line, the sales figures, margins, that's where the health of the company often really shows. And Williams Sonoma saw big moves here.
Big time. Operating margin expanded significantly, climbed to 17.9%. That's up 240 basis points from last year.
2.4 percentage points. That's quite elite.
It is. And their gross margin also looked very healthy, reached 47.1%, which is up 220 basis points.
Okay, let's break that gross margin number down a bit. What drove that?
Well, the main driver was higher merchandise margins. That piece alone added 190 basis points.
Wow. So that's better pricing, better sourcing.
Likely a mix. Could be better terms from suppliers. Maybe they optimize the product mix. Maybe stronger pricing power. Hard to say exactly from the outside, but it's significant.
And the rest.
On top of that, supply chain efficiencies kicked in another 30 basis points.
Okay.
Occupancy costs were up a tiny bit, but the rate itself stayed flat year over year. So yeah, the big gains really came from making more on the products themselves and running a tighter ship on logistics.
So these gains, merchandise margins, supply chain.
Yeah.
How sticky do you think those are? Especially with costs potentially rising, tariffs coming.
That really is the million-dollar question, isn't it? Sustainability.
Yeah.
It hinges on a few things. Can they keep those good vendor relationships? Leverage their scale. That helps merchandise margins.
Right.
The supply chain stuff, if it's structural improvements, that tends to last longer. But yeah, they'll constantly be battling external pressures, tariffs, commodity prices, you name it. It's never easy. But they've built a strong foundation, clearly.
It certainly sounds like it. Okay, we've hit gross margins. What about the other big cost chunk? SG&A selling, general, and administrative. That actually went down.
Yeah, the rate decreased slightly, down to 29.2%, so a drop of 20 basis points.
And what was behind that? Just cutting costs?
Mostly lower advertising and general expenses. But here's an interesting wrinkle.
Oh.
Those savings were partly offset because they paid out more in performance-based incentive compensation.
Ah, so rewarding the team for the strong results.
Exactly. It's not just pure cost-cutting. It suggests internal confidence, rewarding performance even while tightening the belt elsewhere. A little peek behind the curtain.
Good context. And just looking at overall financial health, sounds pretty solid too. Liquidity, cash flow.
Yeah, very strong. They reported $986 million in cash, generated $283 million in operating cash flow just in the quarter.
Healthy numbers. And shareholder returns.
Delivered big time there, too. $280 million back to stockholders. That was $199 million in stock buybacks and $81 million in dividends.
Okay. But you mentioned something earlier, maybe I saw it.
Yeah.
Inventories. There was a big jump there, right? Up almost 18% to $1.4 billion.
You spotted it. Yes, a 17.7% increase in merchandise inventories.
What's that about? Just stocking up, or is there a
Oh,
strategy?
that's really strategic. That increase isn't just random, it's a deliberate pull forward of
A
receipts.
pull forward. Why?
To reduce the hit from higher tariffs they expect later in fiscal 2025. They're essentially buying inventory now at potentially lower landed costs before new tariffs kick in or existing ones go higher. It's a hedge.
That's a gutsy move. Locking up capital, taking on inventory risk.
It is a gamble, no doubt. Ties up cash, increases risk if demand suddenly softens or trends change.
Right, especially in home goods.
Exactly. But it tells you how seriously they view the tariff threat. They think the risk of higher tariffs outweighs the inventory risk.
Interesting. So they're really playing chess with the supply chain here.
Seems like it.
Yeah.
And just for transparency, they did mention a small accounting adjustment too. About $49 million related to past freight expenses.
Okay.
They corrected it, called it non-material for this year or the past, but good they flagged it.
Right, good housekeeping. So with all this, strong performance, strategic moves,
Yeah.
what's the outlook? You mentioned they revised it.
They did, and significantly upwards, which, given all the headwinds we're talking about, is a real statement.
Okay, what are the new numbers?
They raised their net revenue guidance for the full fiscal 2025, now expecting growth between positive 0.5% and positive 3.5%.
And before it was.
Before, the range actually went from a potential 1.5% decline to a 1.5% increase. So this is a much more bullish outlook.
Wow, big shift. What about comparable sales?
Also up, they're now expecting comps in the range of positive 2.0% to positive 5.0%.
And margins. Did they raise that too?
Interestingly, no. They reiterated the operating margin guidance, still expecting between 17.4% and 17.8%.
So maintain profitability despite the challenges.
That seems to be the plan. Keep those strong margins. And remember, this fiscal year is 52 weeks versus 53 last year, but they're reporting comps on a comparable 52-week basis, so it's apples to apples.
Like it. Okay, this raised guidance is even more interesting when you put it right next to those tariff concerns you mentioned. They're being quite open about that pressure, right?
Oh yeah, very upfront. The earnings release, and you see it echoed in analysis like from MarketWatch, explicitly says incremental revenue flow-through will be pressured by incremental tariff costs.
And these costs are serious.
Very serious. We're talking potential new or added tariffs. 30% on China, 50% on India, 20% on Vietnam, 18% average on the rest of the world, plus 50% each on steel, aluminum, copper. It's a lot.
Geez, that's a lot of potential cost increases.
And here's the kicker. Williams Sonoma said their current incremental tariff rate, it's hit 28%. That's double what it was just back in Q1.
Doubled in one quarter. That's huge. How do they even manage that?
Well, they're pulling multiple levers. First, some select price increases, passing some of it onto the consumer strategically.
Okay, makes sense.
Second, pushing back on suppliers, negotiating vendor concessions, trying to get them to absorb some of the cost.
The classic squeeze.
Yep. And third, like we discussed, altering the supply chain. That inventory pull forward is part of it, probably also looking at sourcing diversification, though that takes time.
Right. And Laura Albert, the CEO, she commented on this broader challenge, didn't she, for the whole industry?
She did, and it was quite blunt, really. She said it would be very difficult for the industry to bring a huge amount back to the United States in a short window of time. Why? Because there aren't the factories available.
So not enough domestic capacity to just flip a switch.
Exactly. You can't just onshore massive furniture production overnight. It highlights a real structural limitation. She also pointed out that the cheaper end of the market is particularly vulnerable. Those consumers buy a lot of Asian goods, so they'll feel the tariff pinch more directly.
Meaning prices go up or people just stop buying?
Potentially both. Analysts echo this. The industry might struggle to shift production fast enough, and consumers might just delay big purchases if prices jump too much.
And this is all happening against that backdrop of the housing market, which has been slow.
Yeah, the dormant housing market has definitely been a headwind for home goods, though there is a little positive sign. Demand seems to be picking up slightly as mortgage rates have ticked down a bit.
So a complex picture. Tariffs rising, supply chain stressed, housing market sluggish but maybe bottoming.
It's definitely a complex environment they're navigating.
Yet, despite all that, their long-term goals sound pretty ambitious still. Mid to high single-digit revenue growth, mid to high teens operating margin.
They're sticking to it, which I think really frames the story here. You've got Williams Sonoma showing really strong operational execution, leading them to raise near-term revenue guidance. Right.
But with this huge asterisk hanging over everything.
Yeah.
The significant and clearly increasing tariff pressure They're making smart moves like that inventory build, but it's going to be a real test.
So Williams Sonoma's latest deep dive really shows a company, skillfully navigating some seriously challenging waters, retail, global trade, all of it.
Hmm.
It really makes you wonder, doesn't it? How much can even great execution and smart supply chain moves truly offset these massive macroeconomic headwinds like these escalating tariffs? And what does that ultimately mean for prices, for choices for you, the consumer, in the home goods aisle going forward?